But tonight, I've got Richard Murphy from XTB. He's the Managing Director of XTB. We spoke last week about XTB. We had a viewer ring in and ask about it. And Richard thought, you know, maybe there's a bit more we could offer on the subject. And I said, happy to have the writer reply and come and give me his thoughts on what's going on. So prior to Rudy coming through, and we'll talk to Rudy about Uber, so we can work out how we can get here earlier. But feel free to call us. It's 1300 30 34 35. The email is yourmoney@skynews.com.au. And as I said, here's Rudy waving. That's fantastic. I don't know what to do now. We'll talk to Richard. So, bloke rings through. He sent us an email. No, the bloke that rang through didn't send an email. Another chap sent an email, so that was great. We're going to talk about that email from David. And you thought that maybe I sort of missed his take, that we were pushing a retail guy into hybrids, and we can talk about that later. I thought that XTBs were a bit expensive and it was hard in a low interest rate environment, but you were making the point that you've cut a few of the fees. So tell me a bit about XTB, tell me a bit about how the business is going. And,
yeah, sure.
And we'll talk more about it because there's a lot to it. It's not the same as
growing and
buy that and do this.
Yeah. So basically, for a recap, because you asked me this last time we were on the show a couple of months ago. Basically,
mate,
for those who don't know, XTBs,
it's all a blur. It is, at my age, I can remember when I was about 7. I can remember those things. But last couple of weeks,
XTB, ACDC.
No. Yeah, absolutely. So I'm not good on that stuff. But so tell me
basically, XTBs are individual securities on the ASX that give individual investors the right to get access to the returns from a range of different bonds. So we got 33 there at the moment, so that's 33 separate bonds.
Yep.
And you buy a Telstra one, a Woolworths one.
It's all senior?
One. All senior. They're all senior, and now there's fixed and floating.
So if you think of the capital structure, the senior is the ones that rank higher. They're the ones that in the event the organisation was wound up would be the last that would be asked to bear the costs. Except for those above who are secured. But let's say in a traditional capital stack, equity goes first, hybrids if they're banks or maybe some corporates with hybrids, then subordinated debt, senior, and then whatever ranks above that. It could be term deposits or it could be something that's secured, and they're very safe. The term deposits and things that are secured against specific assets become quite compelling.
I've heard you say this in the show, and your viewers obviously understand this. This actually started me thinking about the capital stack, and we have a chart which we can look at, I guess, when
sure,
they put it up.
We'll look at the chart in a minute.
That really made me start thinking about that capital stack you've just described. Does that have a day-to-day implication for me right here and now? Because if that's National Australia Bank, do I really think we're going to be talking about a default? No, I don't. No. So it's not a day-to-day implication. There's obviously there in the background if something goes wrong. And so when we get to that chart, it'll we actually split it down, saying let's start with cash at the top and look how volatile cash is versus equities.
I'm nodding my head. Can we whip the capital chart up, please? Because you've mentioned it twice. We might as well get it up and we can chat about it. There we go.
That's the chart.
So how do I read this? Let's walk through that.
Start on the left. There's the capital stack that your readers, your viewers should know about now, because it's what we talk about in the fixed income world a lot, with cash at the top essentially sitting in a bank. And let's say this is a bank, an equity at the bottom, and a range of securities in the middle. And then to the right of that, you see the margin over cash. So obviously cash doesn't have any margin over itself, so that's zero, and the rest all go all the way up to equities. To me, that was, well, what does that mean to me? If I'm a day-to-day investor, do I really think National Australia Bank is going to get in trouble? No, I don't, personally. So I will discount that, really, in terms of day-to-day.
I don't either. Just for the record, for those who are watching, I don't think either. Go on.
And you work there.
Keep chatting. So I've got a better insight. So they're going well.
So really, that is obviously then, it's very important when things do go from push to shove and things do go pear-shaped. But from day to day, it doesn't really have an implication. The third column over, which is actual performance of cash at the top, that's a straight line. $100 in your pocket now is $100 in a week's time or a year's time, and that's actually a year-long period. And then you see senior floating rate notes, and they're almost as stable as cash. There is slight, if you can see that on your TV screen, there's a slight wrinkle there. Senior fixed is a little bit more, and then it goes into hybrids and equity at the bottom. There's quite a bit of volatility. Then you can see the annual volatility numbers. So that to me is a day-to-day practical implication. If I'm thinking about constructing a portfolio, yes, I want some equity in my portfolio because equities do exciting things for you. But I also want some anchors, some stability. So you can have that sitting in a bank account in a term deposit, or you can have it sitting in a floating rate note. Now that they're available on the ASX, you could say, well, I'll take a better return than cash for a little bit more risk. But if you look at that performance, even if you go back 18 years, that's very, very stable. There's an 18-year-old index now that's available on floating rate note seniors. It's basically very, very stable, and the most stable securities in Australia.
So essentially, for the viewers that have been looking at that, the key to that is the green lines. Work on those green lines, and I think to some extent, the real question is, can you absorb the volatility? So if you can't take volatility, well, so there's two things, and I think I tried to mention this when the gentleman, I think it was Bill, rang through. And Bill, feel free to call if you want to chat more about it. But when the idea around A, am I being compensated for the risk, and B, can I take the volatility? So when I think of that product, and I think it's, what I did say was it's all about relativity. If the cash market is at 2, and you can offer, which is 75 bips, interest rates are 2%, a term deposit's probably 275. If you, at 75 cents over the cash rate, if you can get 120 or whatever your bonds are trading at, in a low interest rate environment, that's worthwhile. That becomes a significant improvement, a 25% improvement or 35% improvement. Is that where you're trying to win business in terms of, because I can't see a situation where I put all my money into that because of the challenges of reinvestment risk, sequencing risk, the disaster of living on a 3% earning. Where are you winning business?
What we're saying, obviously, it's about overall diversification. So it's not realistic in Australia to say that investor portfolios won't have equity in them. They will, and they've been dominated by equity for many, many a year. What we're saying is, look, if that's your mainstay, if you've got 40, 50, 60% equities, where is the rest? It isn't all sitting in just a term deposit. You want to apportion it out. So if you're saying, well, you've got that in equities, and can you ride out that equity risk? It's been a bad year, but over 10 years or 15 years, you might have done better. And then there's hybrids, and hybrids are generally, some of them more correlated with equities, some less correlated with equities. But our point would be is, well, even if you say you can ride out the volatility, but that could be 3 years, 5 years, 7 years, you have to ride out the volatility for, and not everybody knows that they're going to be in for 3, 5, 7 years. We had a guy buy XTBs from us, and he was definitely in for the 3 years of the bond, but he had to sell 3 months later. Equities had tanked, so he sold the more capital stable instrument.
Yeah, I think you just got to be able to absorb volatility. I don't think you can.
If you hold to maturity, if you're holding to the call date, which is then that's fair enough. But what if you wanted to rotate out halfway through? What if you said, actually, you know what, equity is really cheap, and I want to rotate out of another asset into equities? The best one to rotate out of would be the one negatively correlated against it, which is your senior bond, not the hybrid, which has fallen your equities down because your equities are cheap.
So we'll talk a little bit about that, because I think that's about how you construct a portfolio.
Yes.
And I think that's about what your goal is at the time of writing.
A place in the portfolio, not the portfolio.
We're going to take a first break, and we're going to get Rudy onto the phone. We'll talk about Uber. So we'll be back soon.